So Shopify is one of those beaten down stocks in the stock market, down from $1,700 a share to only $700 a share. And many people here on YouTube are calling the stock a bargain. Now in this video, I'm not gonna really waste your time too much. I'm gonna try to keep it short. I'm gonna talk about what I personally like about Shopify, what I don't like about Shopify, and my personal valuation model on the stock, because it's not really what you buy, but how much you pay for it. And if you're overpaying for a stock like Shopify, no matter how good the business is, you're likely gonna perform poorly over the next period. Now for Shopify, the main reason for this huge down move from 1700 to only 700, it wasn't only because of the Fed and the whole bad sentiment around growth stocks. It was mostly also due to them, reporting lower guidance in the first quarter of 2022. Now that shouldn't be a surprise to anybody, because Shopify has been growing 45 to 50% for a pretty long time. So, you wouldn't be surprised if Shopify grows a little bit lower in the future, but the analysts, they still expect 30 to 35% growth for Shopify over the next 5 years. And this is really the kind of growth numbers I used in my valuation. So what I really like about Shopify is its market share, over 10% market share on e-commerce, just behind Amazon on 41%. And this is pretty amazing. If we look at the retail sale penetration in terms of online sales in 2022, now it's only 17%, and is expected to reach 23% in 2025. And even 23% is a little bit low on the retail sales. It should be maybe 35 to 40%. It's much higher in China, in South Korea, and many other nations. So really, kind of Shopify is not really going to have much of a hard time to really grow. Its TAM is pretty much unlimited, so that's a really good thing for Shopify. Second thing, they were showing pretty strong profit growth. If you look at the gross profit, they've been going up parabolic as they expand their services and many other things. All those things I really love about Shopify, and most importantly is actually the balance sheet. Now, if we look at their balance sheet, it's pretty amazing. It's one of the best really balance sheet you could find. You just look, all the current assets are 8.5 billion, right? And all their liabilities are only around 1.5 billion. So they can wipe out their liabilities, just like that, and then have pretty much a lot of cash to go around. If you look at their net cash position, it's around $8 billion, which is pretty amazing. It's gonna really help Shopify grow more and more in the future. Now I'm gonna get into what I don't really like much about Shopify. Now, first of all, if we look here at the income statement, right, they have their revenues from subscription solutions, and then merchant solution, which I believe is like a commission they get on the sales and stuff, which is pretty nice. Now, if we do have a lot of inflation, maybe we have slower sales online. Okay, this number right here, the 3.2 billion, may start going down. I'm not saying this is a big kind of risk for Shopify, but I'm saying this is something you have to consider. Okay, so this is a total revenue 4.6 billion. They have their cost of revenues, and total net is around 2.4 billion. Okay, now this is really not bad. Now, if we do go down more a little bit, the sales and marketing, it has been going up. So if we just take the sales and marketing, research and development, massive amounts of money spent on research and development, this is one of the things I don't really like in those companies. Now, you may say, yes, but they are spending on research and development and sales and marketing right now just for them to kind of grow and then be dominant. And then in the future, they're not really going to spend that much anymore because they're going to be dominant. Well, you could make a counter argument on that, is that if you look at the retail sales, if they are still so low in the United States and only 18% online penetration, you have to think about the potential competitors that can come in the future. Yes, people are familiar with Shopify, they like to use it, they don't really like Wix.com or the other websites, but maybe something like Shopify or even better is going to come in, and then it's going to try to take market share from Shopify. And if that's the case, Shopify would have to spend even more on research and development and sales and marketing. They cannot cut on that stuff, because as soon as they cut on sales and marketing and research and development, that's mostly sales and marketing, the revenue growth, all those massive growth numbers you've been saying about the 35, 40, 50%, all those are going to go down, and those you have to take into consideration. Now, this is kind of massive operating expenses. Now, the company is valued around $100 billion, right? Now, out of $100 billion, you're only getting $268 million incomes from operations. And yes, it is improving very much from 90 million in 2020 to over 268 million in 2021. But for paying $100 billion to only get 268 million, this is not really a good business. And I just can't really see how this could kind of get better for Shopify. So let's assume, I don't know, 3-4 years from now, let's assume that jumps from 268 million to $1 billion, right? But you're still, let's assume you're paying 100 billion. This is still over 100 times. So this is really not good. Now you may come here and look at the net income and say, oh, look, but they made 2.9 billion in net income. This is massive. Yes, but you have to take into consideration that here in the other expenses or income, they included kind of their gains from their equities. They have some marketable securities and stocks and other stuff. And the SEC rule requires them to report those are either gains or losses. For example, in the latest quarter, they lost 500 million on their kind of stocks or the equities that they really own. Now, they didn't really lose 500 million, but this is how they have to report it with the SEC and stuff. So for them here, over 2.8 billion only came from the marketable securities. So if I ignore this number, they made 268 to 300 million into somewhat of a net income for Shopify. Now for $100 billion company, this is really, really a lot. And even if it jumped to $1 billion and you're paying 100 billion right now, this is still pretty expensive to me. Something else I looked at, many of you told me don't look at the price to sales. Well, if I just look at the enterprise value, okay, and for gross profit, enterprise value to gross profit multiple, and I compare Shopify, it's not really something close to Shopify, but it's pretty close, right? So Shopify now is trading, as you can see, at 37 times enterprise value to gross profit, and it has pretty high growth in the future. C Limited, they also have pretty high growth in the future, and it's trading at 17 times, less than 50% less than the Shopify. If we look at Wix.com, maybe it's not really the best of all, but Wix.com also have, 20-25% growth. It's also kind of trying to be profitable and stuff, and it has only trading at 5-time multiple for Wix, okay, the lowest 5 times. If we just look at Mercado is pretty amazing kind of business model with also the same growth as Shopify. Mercado is trading around the 17 times, also 50% less than Shopify. So Shopify is not really a bargain if you really think about it. Now, it used to trade as high as 100 times enterprise value to gross profit. So for me, Shopify itself is an amazing business model, but I don't really like the valuation. Now, the analysts expect 30 to 35% growth over the next 5 years in terms of revenues, and then they expect a decline to 20 to 25%, after the first 5 years, which I think is pretty fair, and this is what I really mostly use in my valuation model. And this is my valuation model on Shopify. By the time I'm speaking, Shopify is trading around $93 billion. They made $4.6 billion in 2021. Now for my gross numbers, I use 35% over the next 2 years, then 30% on the other 3 years. And I think you guys can agree with me that those are pretty realistic and pretty fair numbers. Now, if Shopify achieves those numbers, okay, they're going to have around $18.5 billion. Now, most software as a service companies like Shopify, they normally have around a 20% net income margin. So I assume that by 2026, Shopify's business model is going to get more efficient and they're going to be able to generate around a 20% net income margin. This would get me around $3.7 billion of net income. Pretty amazing, right? Now, for the PE ratio, I used a 40 PE. And many of you may ask me, why did you use a 40 PE? Well, another kind of company I looked at, it's not really similar to Shopify, but it has over 93% subscription business model, and this is Adobe. Adobe is trading around a 45 PE, and it's also growing 20 to 25%. So after 5 years, Shopify is going to be in the same position as Adobe, and if it trades around 45 PE, I think it's going to be pretty fair for the company. Now, if we put a 40 PE on Shopify, although Adobe has a 40% net income margin, and I don't think Shopify can achieve that. But if we just put a 40 PE, this is a market cap of 147 billion, or only 59% on the upside. Now, if you want to take the best case scenario, I don't know what PE would you really use. I mean, if you use a 50 PE on the stock, which I think is more than fair, is only 99% on the upside. So you basically double your money over the next 5 years. Okay, so for me, based on this this kind of valuation, Shopify is now a much better buy than what it was at $1,700 a share for sure. But for me, it's not really cheap yet. I want between 150% to over 200% on the upside, and 40 to 50 PE could be even a little bit high. I mean, if you use a 30 PE, for example, just to look at it, 30p is only 19% on the upside. Okay, this is not good at all. Now, many of you may tell me, why are you not using 10 years out? Why are you using 5 years out? Well, I think most people have not really learned their lesson that if you use 10 years out numbers, you can really overpay for the stock, because any company 10 years out, you're going to make money on it. It's just going to depend how much. So my rule of thumb with those companies, if I can get 2 to 3x my money over the next 5 years, for me, this more than justifies valuation. If I look 10 years out, the numbers may look amazing, but I might overpay, and I don't want to overpay whenever I buy a stock. But now you watch my video and you could make your own decision. I hope you enjoyed it. If you liked it, please press like and maybe consider subscribing. So I hope to see you in another one.